It's official, the most expensive part of buying a barrel of oil is the barrel. Sorry I'm rocking a less 5 o'clock, more midnight shadow, but I just put this episode together in a bit of a hurry. As of the recording of this episode, you can get a whole barrel of crude for the price of a foot-long sub. To put that in perspective, the oil price is generally between $50 and $100 a barrel. So what the heck just happened? Because as of last week, I was doing a report about how all the OPEC leaders had come together to hold hands, sing Kumbaya, and cut oil production by the largest amount in history. Well, the problem is, nobody wants it. If I cough into 50 plastic baggies and my solution to not being able to sell them is, well, I'm only going to cough into 20 plastic baggies. That's right, less supply. Want it now? Then I'm in business trouble. Now some of you might be scratching your heads quite a bit because, doesn't America really want oil? It was that and razor phones that defined the early 2000s. Well, the problem comes down to both a breakdown in supply and demand. First, locking down 2/3 of the world population isn't great for boosting demand in transportation. Similarly, during a pandemic, locking yourself in a large tube with a bunch of strangers on the water or in the air is not in demand. The only people still buying things from airlines and cruise industries is Congress. Hot tip though, cough once and you get both the armrests. So that's the demand side of the problem. Let's get to supply. Didn't the OPEC nations just cut the heck out of the supply of oil?
Some breaking news now. The world's largest oil producers have agreed to the biggest ever cut in oil production.
Well, let's unfurl that mission accomplished banner and pat ourselves on the back for a job well done. Oh wait, the price of oil is officially negative in some areas? Which means that some producers are literally paying people to take oil off their hands? Well, let's quietly refurl that mission accomplished banner. The problem here is supply. Countries saw the super cheap oil and thought, now's a great time to refill our strategic oil reserves. And then they refilled their strategic oil reserves. Seeing the prices were still super low, they thought, well, there's a hole over there that could perfectly fit some oil. Maybe I'll turn that into a storage site. So they filled that up too. Seeing the oil prices were still low, they thought, well shoot, what the heck else can I do with all this oil? I mean, we could really light up the Statue of Liberty's torch, or, hear me out, crank up the showmanship a little bit on that eternal flame. Eternal Inferno. I'd visit that. Point is, countries shoved cheap oil into every nook and cranny they could fit it in. And yet, more oil kept coming. At this point, Uncle Terry's pool might soon be part of the strategic oil reserve. Because of this, a few things are happening. First, during the OPEC negotiations, Mexico negotiated that they would have to cut their production by significantly less than other countries, meaning they'd get to make more oil. Turns out, that was a terrible idea. Mexico's state-owned oil company officially has too much oil and nowhere to store it all. This means that they are literally just pumping it into tankers and other vehicles with no destination. Just floating. The current cost of holding cargo in a ship off of a major Mexican port past the delivery date is $25,000 a day. There are at least 6 tankers carrying fuel anchored off of Mexico's east coast, and there are other freighters just sprinkled across the rest of the Mexican coasts. This is why they're literally just paying people to get all this damn oil off of their hands. Of course, Mexico is not the only one reeling in this epidemic. Enter United States future traders who are in an almost comical problem. We'll just put it this way. The futures look bleak. A future is essentially a contract between a buyer and a seller to, at a future point, buy a set amount of an asset at a set price. In this case, oil.
When someone enters a future contract, they are obligated to carry out the transaction for the underlying asset in the future at the delivery date, no matter how profitable or unprofitable it ends up being.
This is generally not a problem, but guess what? Oil is finally arriving from Saudi Arabia, and it's yours. Congratulations. Futures traders who would normally be able to shift from the expiring contract to the next are finding very few buyers for the expiring May contract, because very few people want to actually take delivery of oil barrels right now, leaving it something of an orphan. Of course, this begs the obvious question, what are you going to do with all this oil? Well, for the first time in history, people are actually paying other traders to take these futures off of their hands. Stephen's coffin a bag patent pending isn't looking like that bad of an idea anymore, is it? At least you can store those. So what's the effect of this complete mismatch of supply and demand? Well, one of the first effects is, I think Bernie Sanders might have made a deal with an evil genie.
Now is the time to end fracking.
Well, your wish is my command. U.S. shale producers need $40 to $50 a barrel to pay the high-yield bonds they use for financing. And, well, I wouldn't hold my breath for those prices anytime soon. Quite a few shale companies are probably going to go out of business unless the government steps in. And, oh boy, would that be quite the partisan fight. This industry gives America negotiating power on the global stage when it comes to oil market and sales, and it provides a lot of high-paying jobs domestically. Only problem is that some of those high-paying jobs are class-action lawyers, medical professionals, and toxic cleanup crews. Now, one other group being hit particularly hard are countries that really went all in on their oil industry a few years ago. Especially your Irans and Venezuelas. Nobody wants what you're selling right now, and you're going to have to pay to store it. I mention Iran and Venezuela specifically because on top of their one export being worth about as much as a Blockbuster gift card, America is actively blocking aid to those countries. Because their oil companies are state-owned, well, their revenue is non-existent right now, which is not a great position to be in during a global health crisis and pandemic. Beyond that, in a lighter note, if you've ever wanted to own a tanker full of oil and get paid to do it, well, today might be your lucky day. Shipping is about to be very cheap if you're a barrel half full kind of person, and if you need to drive anywhere, I've heard gas is less than $1 a gallon. Great value for your Hummer during your next Liberate the State protest. Not gonna find a Prius in that crowd. So that's what's currently happening with oil prices. Until next time, thank you, and that's all I have to say about that. First, I'd like to thank my patrons for helping me put out my videos. If you want to support independent, nonpartisan news looking into the overlooked, join this growing list of exceptional individuals by clicking on that link in the description. Remember to subscribe and ring that bell so that freedom will continue to ring. Lastly, and a little early on that thumbs up, give me a thumbs up if you like what you saw. And lastly, as always, thank you for watching.
Welcome to this quick video to explain what is going on in the oil market right now. To understand what's happening on the screen in front of you, you need to understand a bit about contango and backwardation. So I'm going to get onto that in just one moment. But let me have a look at the live prices now. May oil futures, you can see this right on the ladder in front of me. May oil futures are trading at minus $40 a barrel. In effect, you can, or if this could happen, you could buy oil for delivery today at negative $40. I've been trading for nearly 20 years. I've never seen anything like this quite so sharply. On this chart, I'm actually looking at the relationship between May oil compared to June oil, and it's showing minus 20. That's not true, actually, because if May oil is trading at now minus $35 a barrel, June oil is trading at $20 a barrel, and this is a $50 difference between the price of oil for delivery today compared to the price of oil for delivery in June. So this is absolutely phenomenal. Oh yeah, now that chart has caught up. The spread's caught up there. That's more like it. Minus 57. Minus 57. There's a $57 spread between May and June oil delivery. I've never seen anything like this. So in order for you guys to understand what's going on, let me explain a little bit about some deep theory when it comes to understanding the oil price. I'm going to talk about when I last saw something like this in 2011 when we had the Arab Spring. So I'm going to try and keep this short and sharp. First of all, this is a quick Bloomberg chart showing, well, just what I've shown you, the front month, so the oil price for delivery now being much, much cheaper than the oil price for delivery in the future. I'm going to come back to that chart at the moment. The last time that we saw something like this was in 2011 during the Arab Spring, and I remember this really well. This is when, I don't know if you remember, the fruit seller in Tunisia set themselves on fire in protest about the regime, and that spread across northern Africa into Egypt in Tahrir Square when Mubarak got deposed by the military, and then it moved into the Middle East with Bahrain and Oman. And what happened during this time in 2011 is a lot of US traders took delivery of oil. So normally when you trade in the futures market, 98% of those contracts being traded don't go to physical delivery. But back in 2011, a lot of the US traders took delivery of oil and Cushing became full. Cushing is a huge storage facility in Oklahoma where a lot of US oil gets stored. The USA has diversified its storage capacity somewhat since 2011 for sure, thanks mainly to the Seaway pipeline. But the Cushing element is still a big factor here. So when Cushing became full, what that meant was, so let's have a look at the spread now, minus 33. What that meant was, if Cushing is full, if I was to buy oil in the futures market here, if I was to press buy, then I've got to take delivery of it. But if the only place I can store it is already full, then I've got a real problem on my hands because I've got nowhere to put it. Now, what happened in 2011, just to bring everyone back up to speed, was that meant that the price of US oil, despite everything that was going on in the Middle East with the Arab Spring, the price of US oil actually started to tick lower. And that confounded a lot of my colleagues who were trading the spread between Brent, that's the oil that derives its price from the North Sea, and WTI, that's US oil. A lot of traders would normally trade the relationship between Brent and WTI because they would tend to move together. What we started to find in 2011 is the WTI price started to move lower and the Brent price started to move higher. And that's because there was nowhere to store it. And that's exactly what we're seeing in the prices today. I don't know how many traders out there remember this and can relate to this scenario, but that absolutely what's happened since the coronavirus outbreak and since the Saudi-Russia power play is that storage capacities have been getting full. No one wants to receive oil now. They don't have anywhere to put it, which is why it's absolutely fine to receive it in June. We're trading at $20.39 in June. For December oil, we're trading all the way at $32, certainly, but for oil now, no one's got anywhere to put it. To understand why that's the case, let's have a look at the difference between contango and backwardation. I'm going to try and make this as simple as possible. So, in a normal commodity market where you have to look after a product and store a product, you would normally have something called a cost of carry. The cost of carry is the price that you have to pay to ask someone to store your commodity for you. So let's say if you look at a product like gold. If I wanted gold today, then I could buy it today for around $1,700 an ounce. That's great. But if I went to an exchange and said to the seller, I want that ounce of gold that you've got in front of you, but I don't want it today, I want it in 12 months' time, then the seller of that gold is going to have to store my gold for me. And whilst he's storing my gold for me, he's not going to be able to do anything with the money that he could have got for selling it to somebody else. So he'll probably charge me what's called a cost of carry. And I want you to look at this chart now as like a snapshot, like a photo. Imagine this point here is now, and I'm looking for that gold to be delivered to me in a year's time. Well, obviously, each month there's a charge, there's a cost of carry, and therefore the price of gold in a 12 months' time, if I want to secure that price now, is going to be higher than if I want gold delivered today. Okay? So that's what we call a normal commodity curve. When there's a cost of carry, you've got to pay the seller to basically hold that commodity for you and pay the opportunity cost of not having sold it to somebody else. However, oil normally works differently. Oil is normally considered a market in finite supply with high demand, and rather than having this yellow normal curve, we get an inverted curve. And it's this inverted curve that means that there's a real belief that there's limited supply, and there's a belief that there's high demand, and therefore people are willing to pay more to receive oil now than they are if they have to wait. And the shape of this curve Well, the slope of the gradient of this curve is really determined by something called the convenience yield. If I find it incredibly convenient to have it delivered to me now rather than in 12 months' time, then I want to pay a higher price for it now. If you're going to make me wait for 5 months to receive this commodity that I believe is in high demand and limited supply, then I'm going to pay a lower price for it. So the first thing to understand here, in a well-supplied market, you get a normal curve. As you look out into the future, the price increases because the price contains the seller's cost of carry. Okay? When you have a market with limited supply, the curve is inverted because the buyer is saying, even though you've got a cost of carry, I don't care. I want this now. It's an in-demand product, and I'm willing to pay a higher price for it now. So the longer you make me wait, the lower I'm willing to pay for you for the product. So that's a snapshot. If that's a snapshot, then what happens then over time? Well, over time, this is the expected future price of the product, okay? This is a meandering along over time till maturity. Normally, a product that's in contango, so with a normal curve, normally, a normal curve, which is this yellow curve, okay? That divergence as a result of the cost of carry dissipates over time as we move forward in time. So the curve is moving lower and lower and lower and lower until we reach the spot price. However, when we have an inverted curve, as we often see with oil, that futures price moves higher to meet the expected future spot price, because obviously as time passes, it's less convenient for me to have it earlier because we're getting closer to the expiration of that futures contract. So in oil, futures contracts expire every month, okay? Normally, oil has an inverted curve and is in what we call backwardation. Backwardation means the nearer price is more expensive than the farther price, okay? The farther price is cheaper, which is why over time that farther price has to move higher in order to meet the current spot price that we see trading physically, the oil that you can actually see and touch. So what's happening that's strange now is actually all about convergence, and I've had a lot of people ask me about this question. We're now trading at minus $25 for the May future. A lot of people are saying to me, this doesn't make any sense. You might as well buy oil now in the futures market, get it delivered to you, hold it for a day, and then sell it for $20. You're making $44 a barrel. If you do that for 100,000 barrels, and that's a significant trade that you're looking at, and it's here, it's available now, if you had somewhere to put it, if you had the capacity to take oil now, if you had the margin, if you had the funds, if you wanted to take oil now. What's happening now, and look, we were nearly $40, minus $40, we're back already to minus 23. What's happening now with this oil futures contract that's about to expire, no one wants to touch it. You know, you've seen this, the liquidity is coming back slightly, but you've got severe gaps in liquidity, which means that, look, everyone's now moved over, we've rolled over to June, despite the fact it looks like there's money on the table here now for anyone that wants to buy this May futures contract. There's nowhere to put it, there's no appetite to do so, and it creates a severe distortion to prices. Talking about distortion to prices, I'm going to come back to those conclusions in a moment, but I wanted to also then look back to 2008. This is the interesting thing I find about markets. Patterns repeat themselves. Here we actually traded nearly $150 a barrel. This is during the financial crisis, by the way. We started to sell off, and this is when we had a $40 spike in oil. And again, that was all due with the calendar month rollovers. Many traders were short, they were holding onto their short positions, and all at the same time they got squeezed higher, pop, and had to exit their positions before expiry, which normally happens about 9 p.m. UK time. So in conclusion, I want you guys to understand the relationship between the current price versus the future price is normally a function of supply and demand, and that ratio between 2 calendar months is normally a function of supply and demand. Contango and backwardation strategies allow traders to take advantage of expected convergence and the change in that convergence from the future price to the spot price. But what we're seeing now really is quite unprecedented. And this is the kind of trend that traders need to be absolutely aware of when, if you are executing an arbitrage trade, that means you're trading one product against the price of a related product. And a lot of traders do that for years on end. If you are trading that sort of spread or arbitrage trade, you absolutely need to be aware when these correlations break down, and you need to recognize this for the type of unique event that you're seeing in front of you in the screen. I hope you found that session useful. Please do ask us directly if you've got any questions at all. info@amplifytrading.com. Thanks for your time.